Scheduled algorithms are a category of execution tools that send orders to the market following a plan based on historical volume patterns or specific time intervals. The main reason traders use these is to minimize market impact. They are especially useful for portfolio managers or traders who have a higher risk tolerance for longer execution times and want to avoid moving the price against themselves. Ideally, you would use a scheduled algorithm under a few specific conditions. First, when you don't expect any adverse price movements while the trade is being executed. They are also best for relatively small orders, typically those that don't exceed 5 to 10% of the expected daily volume. You'll want to use them for stocks that are relatively liquid. Finally, they are a great fit for risk balance baskets, where trading every order at a similar pace helps you maintain that specific risk balance throughout the day. Now, let's look at the first type of algorithm, which is the percentage of volume or POV algorithm, or often called the participation algorithm. The core idea here is that the algorithm executes orders based on a set participation rate of whatever is actually happening in the market. It is highly adaptive. If market volume and liquidity pick up, the algorithm automatically trades more shares. If things quiet down and volume decreases, the algorithm scales back and trades fewer shares. For example, if you set a 20% participation rate, the algorithm aims to match that slice of the tape. So, for every 10,000 shares traded in the market, your algorithm will execute 2,000 shares. The biggest advantage of this approach is how it effectively capitalizes on real-time liquidity. It naturally blends in by only being active when the rest of the market is active. However, there are two main disadvantages to keep in mind. First, it can be more expensive because it effectively chases volume. This means it might continue to buy as prices are moving higher or sell as they move lower. Second, there is no guarantee the order will be finished within a specific time period. If the market is dead, the algorithm stays quiet, which might leave you with an uncompleted order at the end of the day. So the POV is about matching the market's rhythm, even if that means sacrificing some certainty on when you will finish the trade. Now, we are moving into the two common time-based strategies, VWAP and TWAP. Unlike the POV algorithm we just discussed, both of these follow a time-specified schedule. This means they are designed to trade a predetermined number of shares within a set time interval, rather than reacting purely to live market volume. The core advantage here is certainty of execution. Because the schedule is fixed, it ensures that your specified number of shares are actually executed within your desired time frame. However, there is a core disadvantage to this rigid approach. Because the algorithm is on the clock, it may force trades even during periods of insufficient liquidity. It basically lacks the flexibility to pause, so it might fail to take advantage of better market conditions that appear later in the day. Think of these as the discipline algorithms. They prioritize hitting your time deadline over waiting for the perfect liquidity moment. Now let's focus specifically on the volume-weighted average price or VWAP algorithm. This strategy works by slicing your total order into smaller pieces based on historical intraday volume profiles. It essentially looks at how a stock has typically traded in the past to decide how to trade it today. Because of this historical focus, VWAP execution typically follows a U-shaped curve. You will find the algorithm is much more active at the market open and close, while it pulls back and trades less during the midday lull. It's simply following the natural trend of when most shares change hands. However, there is a specific risk to keep in mind. VWAP may not be the best choice for illiquid stocks. If the actual market volume on a given day turns out to be significantly lower than what we have seen historically, the algorithm might not be able to complete your order. In short, VWAP is great for blending in with the crowd, as long as the crowd actually shows up like they usually do. Finally, we have the time-weighted average price or TWAP algorithm. The mechanism here is very straightforward. It slices your order into equal amounts to be sent to the market following an equal weighted time schedule. Unlike the other algorithms we have looked at, TWAP doesn't try to time the market based on volume or liquidity. Instead, its execution is completely constant. It sends the same number of shares and the same percentage of the total order in each designated time period until the job is done. Because it's so predictable, TWAP is a solid choice when you want a steady, systematic entry or exit over a fixed period of time without any complicated bells or whistles. Imagine a trader needs to buy 6,000 shares within a 3-hour window, specifically between 10 a.m. and 1 p.m. If we set this algorithm to trade every 60 minutes, that gives us a total of 3 trades over those 3 hours. The math here is very simple. We take the 6,000 shares, divide them by the 3 trade intervals, and the algorithm determines that it needs to buy exactly 2,000 shares per trade. Now, look at the table to see how this actually plays out regardless of what the market is doing. At 10 a.m., the market is very busy, but the algorithm just sticks to its 2,000 shares. By 11 a.m., the market has gone dead with very low volume. A more adaptive algorithm might pause here, but the TWAP stays on schedule and forces that 2,000 share buy anyway. At noon, the market picks up slightly, and again, the buy amount remains exactly 2,000 shares. So this highlights the core nature of TWAP. It's incredibly consistent and ensures you finish on time, but is completely blind to liquidity. It will execute its slice of the order at the scheduled time, even if it has to be the only participant in a quiet market. Now, in this scenario, a trader needs to buy 6,000 shares using the VWAP algorithm. Unlike the steady drip of a TWAP, the VWAP algorithm is going to allocate those 6,000 shares based on historical volume patterns. Take a look at the data in the table to see how the U-shaped curve we discussed earlier actually works in practice. So during the market open in the morning, historical data shows that 40% of the daily volume usually occurs. Following that lead, the algorithm executes a large portion of the order. So 40% of 6,000 shares would be 2,400 shares. This is to match that high liquidity. At midday, during the typical lunch lull, historical volume drops significantly to just 10%. To avoid having a large market impact when fewer people are trading, the algorithm scales way back and only buys 600 shares. Then, as we head toward the market close, volume historically surges again to 50%. The algorithm ramps back up, executing the remaining 3,000 shares to finish the order. By mirroring the market's natural rhythm like this, the VWAP algorithm helps the trader blend in with the crowd, ensuring they get a price that is consistent with the day's average volume-weighted price.